There are 3 tactics that every successful trader masters in order to achieve their success. Now, as we go through this video, I want you to think about how you can incorporate these tactics into your own trading strategy. What are some of the weaknesses in your current approach, and how can you improve on these tactics when you're fitting them into your own methodology? Number 1, the ability to quantify potential outcomes, also known as a probability assessment. All professional traders do this in one form or another. When I first started trading, like most traders, I had no rhyme or reason to my approach. I tried momentum trading based on news events. I tried making predictions based on technical analysis, but nothing seemed to work consistently. But then I started reading books on trading and investing. Books like The Intelligent Investor by Ben Graham and Options as a Strategic Investment by Larry McMillan. One thing I noticed was that every single successful trader and investor used probability analysis in their strategy. They never had absolute certainty about their trades. They assigned a probability or a risk-reward profile to each and every trade. As I grew in experience trading, I began to do the same thing. Here's an example from our last video that we published here on YouTube. The market has started to sell off, and we wanted to quantify the odds of breaking this trend line. So let's just zoom in here to this chart. And this was after options expiration on July 19th. And we basically said, we don't know what direction the market's gonna go in the next few days. So we assigned a 50-50 probability that the market could bounce from this level up to new highs, or could continue lower down to the trend line. Pretty simple, but that's just step 1. Step 2 is, what does the market do at the trend line? Well, we assigned a 65% probability that the market would bounce at or around the trend line, and a 35% probability that the market would break through the trend line at that point. So from just this 2-step path dependency, we could say there is a 17.5% chance from July 19th that the market was going to break the trend line. And you can keep iterating on these different points and come up with an entire probability assessment. Now, this was a super simple example where we're using very simplistic estimates and they're not very precise. But what it allows us to do is to think through potential path outcomes. If we assign a 17.5% probability of a trend line break, it helps us to think about the risk-reward trade-off of adding a hedge position to account for that possible event. In other words, it helps us think through the weaknesses in our existing positions. Like, if the trend line breaks, how much are our existing positions going to lose? And so assigning these probabilities helps us to think through this process, helps us to better position ourselves for multiple market outcomes and make more money. Number 2, data and analytics. And this is definitely one of the most important tactics that pro traders use, and that is honing your ability to find important data points and properly analyze them in order to gain an edge over the rest of the market. I've never seen a successful trader or investor that doesn't do this. And for this tactic, charting and technical analysis doesn't count. What we want are metrics that are precise, have predictive power, and maybe a little bit harder to come by. Let me give you some examples to illustrate. Price to earnings versus price to free cash flow. Let's start off by talking about the PE ratio. This is just simply price divided by earnings, and it's a readily available metric that is basically posted on every finance website, and it's quoted by every pundit on CNBC. It does have usefulness, but that data point is not going to give you an edge over the rest of the market because everybody's using that data point. Now let's contrast that with the price to free cash flow ratio. What is free cash flow? Free cash flow represents the actual cash generated by the company that is available for distribution to shareholders or for reinvestment or for debt payments. It's basically, after everything else is paid off, how much cash does the company have left over? If we're just looking at earnings, on the other hand, which is the E in our PE ratio, earnings can be influenced by non-cash items like depreciation, amortization, and accounting policies and practices. These can be affected by management and can be kind of skewed from quarter to quarter. So earnings don't always reflect a company's true financial health, especially in the short term. So the price to free cash flow ratio ratio is a much more precise metric, especially when comparing similar companies within a sector. This metric can give you insights into the true financial condition of a company, and thus it can give you an edge in your research and analysis. This is particularly true in market downturns, when cash flow is a really important part of the investment decision. Investors are less focused on growth and ideas, and they're more focused on cold hard cash. Here's another example: gamma exposure. If you've watched our previous videos, you know that we utilize GEX to make predictions about market direction, supply and demand, market concentration, etc. I'll link below to our GEX playlist if you want to go down that rabbit hole. The cool thing about using GEX is that not many traders and investors have access to it, let alone even understand how to use it. If you're not familiar with gamma exposure, it allows you to see several things in the market. Number one, it shows you where market participants are positioned, so you can quickly see levels where price is likely to gravitate to. Number two, you can infer what option dealers are doing in the background of the market, which can allow you to take short-term tactical trades at precise price levels. So understanding and using GEX gives you a huge edge over the rest of the market. By the way, if you're interested in checking out our gamma exposure tools, our 5-hour education course, and our trading community Discord, I'll put a link to our website below where you can check all that out. Number three, risk management. Risk management is probably the least sexy of these three tactics, but you know what's even less sexy? Losing a lot of money. So every successful trader has a precise risk management tactic baked into their overall trading strategy. I know a lot of traders talk about using stop losses or trailing stops. Those tactics are often necessary to mitigate losses. But a true risk management approach, a comprehensive risk management approach, is way more than just stop losses. Successful traders incorporate risk management into the very essence of their trading. Let me give you some examples. Diversification. Diversification, for example, would be sector analysis, avoiding over-concentration in any one sector, like not going all in long on tech, for example. Laddering expirations. This is particularly useful when trading options, and you've got multiple positions. You may stagger your positions out over various expirations up the options chain. Sizing. Not risking more than 1 to 3% on any given trade. This is a huge risk management principle. A lot of traders ignore this, but every successful trader has a precise mechanism for sizing their trades. Incorporating asymmetric risk-reward profile. For example, long-short plays, pairs trades, etc. So in summary, the three tactics are quantified probabilities, data analytics, and risk management. These are the three tactics that successful traders can't live without. And we do a deep dive into each of these topics in our Geek University course. It's a 5-hour trading strategy course, which is free for all of our members. So if you're interested in becoming a member, I'll put a link to our website below. You can check that out. Also, don't forget we have free access to our trading community Discord. A lot of great traders in there. Come on in, say hi, link in the description below. I hope you were able to get a lot of value out of this video. Thanks so much for watching, and we'll see you guys in the next video.